So imagine a company that loses $80 million in just 6 months, badly misses its revenue targets, and watches its own insiders quietly sprint for the exits.
Yeah, you'd think the stock would just absolutely tank.
Right. But in response, Wall Street bids the stock up by like 7.5% in a single afternoon.
It's wild.
It really is. So
Yeah.
today on our deep dive, we're looking at USA Rare Earth. And we're trying to figure out how a business with numbers this disastrous is being treated like, the next market darling.
It is honestly the ultimate market disconnect. I mean, you are watching present reality just actively colliding with future possibility.
Exactly. And unpacking that massive contradiction is really our mission today. We're going to comb through the latest equity research, the SEC filings, market data to figure out why this company, despite severe operational losses and a really aggressive cash burn, is seeing this absolute surge in market optimism.
Yeah, because we really need to weigh the reality of their ledger against the ambition of their blueprints.
Because there is a very specific narrative being sold to the market right now.
Oh, absolutely. And clearly traders are buying it. But, when you actually look under the hood, the mechanics of how this company is supposedly funding its grand vision are just full of strange anomalies.
And unconfirmed rumors, too.
Yeah, exactly.
So whether you're actively managing a portfolio, analyzing market trends, or honestly, if you're just fascinated by the messy intersection of big business and geopolitics, this case study perfectly illustrates the tug-of-war between cold data and compelling narratives.
It's a classic setup.
Right. So let's get right into the ledger. USA Rare Earth recently reported their second quarter results for 2026, and it was a definitive double miss.
A really severe one, too.
I mean, they brought in $5.82 million in revenue.
Which sounds okay until you realize the market was expecting them to clear over $8 million.
Right, so they missed their top-line estimate by over 27%.
Yeah.
And then on the bottom line, the earnings per share came in at a loss of 15 cents, which was worse than the estimated 13-cent loss.
So basically, they lost more money than expected while making less money than expected.
Which is just the worst possible combo. And if you zoom out to the first half of 2026 as a whole, the picture gets even darker, right?
Oh, much darker. I mean, they posted a net loss of over $80 million.
Wow.
And more critically, they burned through $75.3 million in operating cash flow.
Okay, wait, stop right there. Let's just look at that math for a second. They burned $75 million to generate, what, around $11.5 million in revenue over 6 months?
Roughly, yeah.
In any normal sector, a burn rate that aggressive relative to incoming cash would have investors running for the hills.
Oh, totally.
I mean, it just screams operational distress.
Well, sure, in traditional retail or software, absolutely. But, in early stage mining and critical materials, capital intensity is just the name of the game.
Right, because you're building stuff.
Exactly. You are building complex processing facilities, you're securing environmental permits, moving literal tons of earth.
Yeah, it's not cheap.
Not at all. But even with that context, I mean, a double miss of this magnitude injects a massive amount of uncertainty into the valuation.
Which is exactly what makes the market's reaction so baffling.
Yeah.
Because despite this dismal report card, the technical data for the stock paints a shockingly bullish picture.
It really defies logic.
It does. On August 14th, 2026, the stock closed at $20 flat. It jumped nearly 7.5% in a single day.
Following a massive earnings failure.
Following a complete failure. And it's not just like a momentary blip either. The stock is currently trading above its 20-day, 50-day, and 200-day simple moving averages.
Right.
So short-term traders, medium-term swing traders, and long-term holders are all collectively pushing the price higher.
Which is wild. And plus, the RSI, the Relative Strength Index, is sitting at 73.34.
And with an RSI over 70, that's screaming overbought.
Exactly. Buyers should be absolutely exhausted by now, yet the momentum just keeps pushing.
So what's driving that?
Well, to understand the psychology behind that momentum, you really have to look at the stock's beta, which the research pegs at 2.72.
Right, beta. I always think of beta like the suspension on a car.
Okay, I like that.
Yeah, so if the broader market, like the S&P 500, is a smooth-riding family sedan with a beta of 1.0, a beta of 2.72 is like the stiff, punishing suspension on a track car.
Oh, yeah.
You feel every single bump in the road, magnified almost threefold.
That's a great way to look at it, actually. A stock with a beta approaching 3 is heavily targeted by momentum traders and speculators.
They like the bumps.
They love the bumps. They aren't looking for slow, steady dividend growth. They want massive, disruptive volatility.
Right.
So for the people buying the stock, that $5.8 million in quarterly revenue is just background noise.
But wait, how can revenue be background noise? I mean, a business eventually has to sustain itself.
Eventually, yes. But right now, the market isn't valuing USA Rare Earth based on what it managed to dig out of the ground yesterday.
Okay, so what are they valuing it on?
They are valuing it entirely based on the strategic choke points it might control tomorrow.
So if the math is a disaster, these investors aren't buying a balance sheet. They must be buying a story.
Exactly.
What exactly is the CEO telling them to keep this momentum alive?
Well, the overarching narrative is decoupling from China.
Right, the big geopolitical play.
Yeah. The CEO recently pointed out that Western rare earth prices are soaring because companies are desperately seeking alternatives to the Chinese supply chain.
Which makes sense.
It does. They are leaning heavily into this concept of a costly premium for U.S. supply chain independence.
Let's explore that costly premium for a second, because rare earths aren't just one generic commodity,
No, not at all.
We're talking about elements like neodymium and praseodymium. These are the permanent magnets in electric vehicle motors.
Right.
They're the key components in offshore wind turbines. And maybe most importantly, they are the backbone of the guidance systems in F-35 fighter jets and advanced defense weaponry.
Which is huge.
Yeah, you literally cannot run a 21st century superpower without them.
And the interesting thing is the bottleneck isn't necessarily the mining itself.
Really?
No, I mean, you can find rare earth deposits in California, in Australia, in Brazil. The true choke point, and the reason China has a stranglehold on the global market, is the refining process.
Ah, the metallurgy.
The metallurgy, the chemical separation, the solvent extraction. It is an incredibly complex, expensive, and frankly, environmentally toxic process.
Oh, yeah, I've heard that.
Decades ago, the West essentially decided to outsource all that dirty work to China because it was cheaper and it kept the environmental hazards offshore.
Out of sight, out of mind.
Exactly. But now, China controls the vast majority of the refining capacity. So even if you mine the raw ore in the U.S., you often have to ship it to China to make it usable.
Wow. Okay, so the narrative USA Rare Earth is selling isn't just about digging a hole in the ground in Texas.
No, it's about rebuilding an entire specialized industrial base that the West abandoned 30 years ago.
And buyers are willing to pay a premium to know their defense supply chains aren't entirely dependent on a geopolitical rival.
Precisely. That's the national security premium at work.
Got it.
The market is betting that the U.S. government and major Western tech giants will subsidize and protect domestic suppliers regardless of short-term financial inefficiencies.
Because they have to.
Right. They are assuming failure is simply not an option for this sector anymore.
Okay, I get that. A great narrative about saving the Western supply chain gets investors in the door. But patriotism doesn't pour concrete.
No, it does not.
You need actual cash to build these complex refineries. And this brings us to the biggest, most confusing logical gap in the entire stack of research we looked at.
The balance sheet expansion.
It is mind-boggling.
Well, it is.
Like, at the end of 2025, USA Rare Earth had about $360 million in cash. But as of June 30th, 2026, their cash and cash equivalents exploded to $1.53 billion.
Yeah, and their total assets are now sitting at nearly $3 billion.
For a company that just reported under $6 million in quarterly revenue.
Right.
So where did this massive pile of cash come from?
Well, the sources point to two major catalysts, really.
Yeah.
An unconfirmed $2.8 billion acquisition of Brazil's Serra Verde mine, and an unconfirmed $1.6 billion in GPS Act funding.
Plus a finalized merger with Texas Mineral Resources Corp. in mid-August.
Yes. But we need to pause here and really interrogate the source of this information.
Definitely.
Because it highlights a massive danger for modern retail investors. The Texas Mineral Resources merger is confirmed, but the $2.8 billion Serra Verde deal and the $1.6 billion CHIPS Act funding.
Yeah.
The research explicitly notes that these are sourced from U.com discovery feeds.
Wait, and a discovery feed is basically an AI scraping the web, right?
Exactly.
It's aggregating news articles, analyst speculation, maybe preliminary letters of intent. It is not a legally binding SEC document.
Not even close. An SEC 8K or 10Q filing means the company's executives are swearing under penalty of perjury that the information is factual.
Right.
But an AI discovery feed might pull a headline that says, USA rare earth applying for $1.6 billion in GPS funding, and package it in a way that makes the market think the check has already cleared.
But wait, this is where the logic completely breaks down for me.
Okay, how so?
If the $1.6 billion in GPS funding is an unconfirmed rumor scraped by an AI, how is there 1.54 million, $3 billion in actual confirmed cash sitting on their June 30th balance sheet?
That is the million-dollar question.
Or billion-dollar question. I mean, you can't fake $1 billion on a quarterly financial report.
No, you can't. It is a glaring discrepancy in the research, and it points to the mechanisms of how these companies actually fund themselves behind the scenes.
Right.
Because if the TPS money isn't finalized, that massive cash influx had to come from somewhere else.
Like where?
Well, did they issue a massive block of new shares and dilute their current stockholders? Did they take on a mountain of toxic convertible debt from institutional lenders?
Well,
the sources just don't clarify the exact origin, which is a massive blind spot for anyone looking at this stock.
and even if it is CHES Act funding that somehow arrived early,
Yeah.
we have to talk about how those government grants actually work.
Yeah.
It's not a direct deposit that you can just spend however you want.
Oh, absolutely not. Government funding of that scale is almost always milestone-based.
Right.
It's distributed in tranches. You build the foundation, you pass an environmental inspection, you get the first tranche.
Makes sense.
Then you install the specialized extraction equipment, you hit a processing quota, you get the next tranche. It is highly regulated, restricted capital.
Which makes the idea of a $2.8 billion acquisition of the Serra Verde mine in Brazil feel incredibly precarious.
Extremely.
I mean, they are a company generating $5 million a quarter, attempting to swallow a multi-billion-dollar foreign asset, potentially using government funds that might have strict domestic use requirements.
Yeah, the execution risk there is astronomical. Integrating a foreign mine of that size requires an army of specialized engineers, lawyers, and international compliance officers.
Which they probably don't have yet.
Right. The corporate friction alone could completely derail a tiny early-stage company.
So we have a mountain of cash with a cloudy origin story tied to a highly complex, unconfirmed Brazilian acquisition. What could possibly go wrong?
So much.
Let's turn to the bear case, because there are some massive cracks in the foundation here.
Yeah, and the most immediate crack is the cash burn we discussed earlier. Burning $75.3 million in 6 months is severe.
Now, I feel like a lot of people might say, well, they have $1.5 billion in the bank, so a $75 million burn rate is nothing. They have years of runway.
Right, but that assumes the $1.5 billion is unrestricted, which we just established is highly unlikely. If that cash is legally earmarked for the Brazilian acquisition, or if it's tied up in performance metrics they haven't met yet, they can't just use it to keep the lights on or pay their day-to-day engineers.
So that runway could evaporate much faster than the retail market thinks.
It really could.
And the red flags aren't just on the balance sheet either. I want to talk about the governance issues.
Oh, yeah, the SEC filings.
Yeah, the research flags unspecific board continuity concerns, highlighted by a cluster of SEC 8K filings in July of 2026.
Which is always interesting to see.
It is. I saw they filed 3 8Ks in a single week, July 16th, July 20th, and July 23rd.
Wow.
In my experience, unless a company is on an incredible hiring spree, dropping 3 8Ks in a week usually means the board is playing musical chairs.
You are absolutely spot on.
Which is terrible look right before a multi-billion-dollar merger.
It's awful. An 8K is the form used to notify investors of a major material event. When you see a rapid-fire cluster like that, it almost always indicates intense, sudden shuffling at the executive level.
Right, like something went wrong behind closed doors.
Exactly. A sudden resignation, a disagreement over corporate strategy, a change in independent auditors.
Someone slammed a door and walked out.
Often, yes. And when a company is trying to execute a transformational M&A strategy, board stability is the single most important factor.
You have to be aligned.
You do. You need a unified vision to navigate the regulatory hurdles of buying a Brazilian mine and utilizing U.S. federal funds. A fractured boardroom during a critical expansion phase is a glaring warning sign that retail momentum traders are just completely ignoring.
Which brings us to the most damning piece of evidence in the entire report, honestly. What the insiders are actually doing with their own money.
Oh, the insider trading data is incredibly revealing.
The research shows an open market sale of 13,000 shares by an insider. And more importantly, Zero open market purchases.
Just think about the psychology here.
Right.
If the China alternative narrative is a guaranteed gold mine, right? If the $2.8 billion Serra Verde deal is a sure thing that will transform the company into a global powerhouse, why aren't the people inside the building buying the stock?
Right. If I was an executive and I knew my company was about to become the heavily subsidized cornerstone of American supply chain independence, I'd be taking out a second mortgage to buy shares while they were only $20.
Exactly. Now, selling 13,000 shares isn't necessarily a massive panic dump. I mean, executives sell stock to pay taxes or buy a house all the time.
Sure.
But the complete absence of insider buying is a glaring bearish signal.
It really is.
It suggests that the people who actually see the internal metrics, the real costs of the Brazilian acquisition, the regulatory hurdles of the refining process, the true origin of that $1.5 billion on the balance sheet, they are perfectly happy to take some chips off the table rather than double down.
It's the classic dynamic of high beta narrative stocks, isn't it? The retail market buys the dream while the insiders quietly manage the reality.
It creates a fascinating disconnect between the people managing the company and the algorithms trading the stock.
So let's pull all of this together. We started by looking at USA Rare Earth as an optical illusion, and I think that holds up perfectly.
It does.
This company is a profound tug of war. On one side, you have confirmed undeniable fundamental weakness. They missed earnings. They missed revenue. They are burning through $75 million in cash every 6 months.
Yep.
Insiders are selling, and the board seems to be in a state of chaotic transition right when they need stability the most.
That is the reality of the ledger, and it is bleak.
But on the other side, pulling with incredible force, you have these transformational catalysts, a $2.8 billion mega deal, billions in potential cheap HAZAC funding,
Right.
and a massive geopolitical shift that essentially demands a company exactly like this succeeds just to break China's monopoly on the materials that run our modern world.
It's a huge tug of war. For anyone tracking this, you really have to watch 3 specific indicators over the next 6 to 12 months to see which side wins.
Walk us through them. What's the first one?
First, the revenue ramp. The narrative has to start paying the bills eventually. Keep a close eye on Q3 and Q4 of 2026.
Okay.
Does that 5.8 million revenue figure actually start scaling up to meet analyst estimates? If they keep logging double misses, the market's patience will eventually snap, regardless of the beta.
That makes total sense. The story has to translate to actual sales. What's the second indicator?
The Serra Verde acquisition and the CTS Act funding.
Right, the unconfirmed stuff.
Exactly. We need to see those move from AI discovery feed rumors to SEC-confirmed reality. Watch for the official closing of the Brazilian mine deal and the actual verified disbursement of that government funding.
Because if they don't get that money.
Without that capital properly secured and unrestricted, the entire expansion strategy falls apart.
Wow. Okay, and the third?
The trajectory of the cash burn. We know operating cash flow is currently negative $75 million.
Yeah.
If that burn rate accelerates without a corresponding explosion in revenue, investors are going to realize that the $1.5 billion cash buffer is a mirage. In the capital-intensive mining sector, cash disappears fast.
It's a race against the clock. Can they build a monopoly before they run out of money?
That is the gamble every single investor buying at $20 a share is taking right now.
Well, as we wrap up this deep dive, I want to leave you with a final thought to mull over. Something that goes beyond just USA Rare Earth's balance sheet and touches on the broader economy.
It's a question we really have to ask as the geopolitical landscape shifts.
Yeah. We've established that achieving Western supply chain independence for these critical minerals, the literal building blocks of our phones, our electric grids, and our national defense, it requires massive upfront capital.
Massive.
And it requires a very high tolerance for continuous, heavy financial losses while that infrastructure is built. So are we entering an era where these vital raw material companies function less like traditional free market businesses and more like subsidized public utilities? Because if the government simply won't let them fail due to national security, and the momentum market doesn't care if they actually make a profit, then the optical illusion isn't just on this one stock chart. The real illusion might be thinking this sector is still operating in a free market at all.
A fascinating perspective, and definitely something to watch as this decoupling continues.
Thanks for joining us as we unpack the contradiction. Keep your eyes on the ledger, and we'll see you next time.